Today we're going to talk about company disclosures and then a little bit about financial statements and the financial documentation that the company produces. What is the main way that the law counterbalances the effects of limited liability and the protection that is offered to shareholders? The main counterbalance is disclosure. So you get to tell people that potentially want to do business with you. You get to reveal a lot of things. If you're a company, you reveal a lot of things about your finances, about your plans, about your organization. So people can then make up their minds as to whether they want to do business with you. On the one hand, you've got this protection from the insiders, but the outsiders get a lot of info. Perhaps if the case was not that, you would not need as much information going out, and that's what you have in partnerships, for instance. Partnerships that do not benefit from limited liability, you don't know a lot about them, but you do know that they cannot tell you that the partnership has run out of money when the partners are personally responsible for making contributions if that happens. Knowledge comes a responsibility, perhaps. Knowing how a company is doing and whether it is solvent or not is something that ought to be communicable through the information that is publicly available. The problem is that people are not necessarily familiar with this type of documentation, so they cannot quite easily understand what these documents are supposed to mean. Yeah? So what we're going to do, apart from introducing generally what is contained in these disclosures, we're going to have a quick look at the sort of spreadsheets and stuff that the companies are giving out. Familiarizes you a little bit with the way this information is presented, so you can have a look at it and determine for yourselves company is still solvent or not. As I said, we already know that there's mandatory publicity requirements for companies, and they're a central feature of the organization of company law. Obviously, the bigger the company, the more information you need to give out. And by big, I mean, are we talking about a company, a private limited company, or are we talking about the public limited company? Because of the higher exposure that the public company has and the potential fluctuating shareholding, then it obviously needs to give higher amounts of information to people who might want to do business with it or want holders. So a company that is public will publish a lot more information than a company who is a private limited company. Now, if that public company gets into the stock market, because you need to remember this distinction, you can be a public company, it's not obligated to be listed in a stock market, but if you are also listed in the stock market, then you need to give additional information about yourself, and this is going to be contained in the listing rules. A large amount of information in a highly kind of stylized way that needs to come out, informing potential purchasers of these shares in a stock market about what the company is and what it does. The information is not only intended to say something to potential shareholders, it's also intended to say something to the existing shareholders, because existing members of the company ought to have mechanisms in determining whether their company is doing well or not. Find this out, I guess, if the company is paying dividends. So if the company has done very well and is very profitable, it's going to pay a higher amount. The lack of dividends doesn't necessarily mean that the company is not doing well. It just means that the company is reinvesting. A process for communication of this information from the company to the outside world, but also from the directors, existing shareholders as well. The directors, therefore, are obligated on an annual basis to produce this information. And this information comes alongside the annual accounts that the directors have to put together, which explain the financial position of the company. The documents that the directors will put together explaining both the finances, but also explaining corporate strategy and a little bit about the plans for the future of the company and how they see everything going. And these are usually presented for the bigger companies that need to have an annual general meeting. This documentation alongside the accounts are presented at the annual general meeting. You will find information about these disclosure requirements in Section 381 of the Companies Act. But all companies, as it says in Section 386, are obligated to keep records sufficient to show and explain the transactions to disclose with reasonable accuracy the financial position of the company. And this is something that is also done to comply with international accounting standards, meaning that this documentation is not only to be understood by insiders or people in this jurisdiction, it's meant to be presented in a way that communicates across borders. So investors that are actually not here can understand and can have faith in the companies giving about in an attempt to describe its financial position. So not only the directors are under an obligation by law to produce these things, but they also need to kind of address it, a narrative explanation of what they've been doing with this whole entire year and what they intend to do in the future. And this comes in the form of a director's report. This director's report is a statement that comes with the accounts, and it is a statutory requirement here, backed by criminal sanction. So if you look at section 415, the directors have to produce the documents, and if they don't produce them, they will end up committing a criminal offense. That's frequently keep telling you that taking the job as a director isn't something that you do for fun. It is something that can have serious consequences, both of the civil and nature, if you fail to have these returns that you need to have on an annual basis. If we're talking about public companies, alongside the director's report, we're also going to have a director's remuneration report that explains how the board, because these are professional managers that get paid more money, this explains how their remuneration is calculated, how much they get paid and why. And you also have, within this director's report, you've got a list of everybody who's a director and a list of the main activities in the course of the year. Plus, it will usually contain some information as to how much dividend is to be paid, which is probably what interests the shareholders the most. And you also have something that used to be called the business review, but now it's called the strategic review. That is the forward-looking document about where they intend to take the company in the future and what they intend to do. Now, all of these things are not a matter of best practice, they're a matter of legal obligation. So they need to put them there. Inaccuracies and mistakes in these reports, they're a breach of the director's duties and can lead to liability of the directors to the company. In some cases, for example, if the information is inaccurate due to fraud, liability of third parties and outsiders. Information about this can be found on section 463, which says what will be the liability for false and misleading statements in the reports. Now, what is important here to understand is that this is mostly understood from an internal point of view as a violation. So it kind of fits in with all the stuff that we've done about directors' duties. It is not easy to have an external person who decided to invest in the company on account of these statements to sue the company for having made the wrong investment. There isn't a direct link of liability for any errors or inaccuracies here to the investing public in general. It gets a little bit worse for the financial information that's in the audit documents that need to be checked by an auditor. They need to be checked by an accountant and validated. Now, all of things, the auditor's report and all the reports of the directors that I mentioned, they're all submitted to the registry. The thing about the auditors is that the auditors are meant to be independent of the company. So the company will hire them. They hire like a bunch of accountants to check what they've been doing. But their duty is not to the company that hired them. Their duty is to the registrar. So they need to make sure that this information is, in fact, independently checked. In bigger corporations that we've got non-executive directors, part of the non-executive director role is to check how the reports are getting audited and whether the information is accurate and how it reflects back to the job that the directors are doing. There will be criminal liability for negligent accounts. There will be criminal liability on the auditors as well for negligent accounts. And it's interesting to note that even though the company itself is not liable for the content of the statements to outsiders, unless, of course, there is fraud, the auditors will be. So the auditor that has validated the financial information might incur liability to the outside public, while the company will not. I'm not saying here that anybody who looks at audited accounts and then buys shares and ends up to have a bad deal is going to claim against the company or the directors, but they will be able to have a claim against the auditors if the auditors have validated wrong information, not having done their own due diligence, not independently. Perhaps the worst consequences are on the auditors, which in a way it's fine because the auditors are hired to be an external referee of this process. Right? The only way that you can go after the company directors or the company itself for financial loss, for investment decisions that you made on the basis of all this documentation, is if there is a direct duty of care. So if a special relationship has been is in existence between the company directors and an outside person who becomes an investor, and that relationship creates a duty of care, and if that duty of care is violated, then you have a personal cause of action. But the core of this is it's a tort action, right? If you have that manifests in tort. And if duty of care is violated, then you have a tort action against whoever has violated that duty. Best case to see about this is the case called Caparo Industries versus Dickman from 1990. Your options are, if you have invested in a company and it turns out that the documentation of the company is not have invested in it if you had seen the accurate information, what you need to ask yourself is, why did you make the decision to invest? Were you invited then? Did you have discussions with the directors, with company insiders that convinced you to do it? So then you're thinking about potentially a duty of care that's been violated. Or you could be thinking about, if the audited, would you have a claim against the auditors if they haven't done their job properly? If you don't have those, then things become a little bit more fuzzy. So then your position as an outsider is not very well protected, but perhaps if you've become an insider in the company, then maybe you can identify breaches of directors' duties, and then you can pursue the directors internally. But again, remember the distinction between personal harm and harm done to the company. If you're already an insider and you're pursuing a breach of directors' duties, any money that you generate is going to be money that goes back to compensate the company for loss suffered by the company, not to individual investors for making decisions. The idea of financial records and documents. There needs to be an agreed way to look at financial information, so then we can compare the experiences of different companies. And this is not something that's obvious. It's not obvious to you because in your everyday life you don't deal with this type of documentation, but also it's not obvious because it's not really that well publicized. Usually you rely on second-hand impression, the profitability or success or sustainability of a company. You don't look at the documents yourself. So if you're interested in buying shares somewhere, most people will look at what does the press say about this particular company, whether it's good or not, or whether it's doing well, or whether the board has got great ideas. They will not look at the numbers themselves. So if you're thinking about, everybody's saying that Tesla is the thing of the future. So if you're thinking of buying some shares in Tesla, it's much more likely that what's going to help you make up your mind is what is said as opposed to you downloading and reading the financial information. But somebody at some point needs to be able to read this financial information. And in order to read it and understand it, each company cannot be putting together its accounts in whichever way it wants. So there are accounting standards that not only are they consistent for all companies within a jurisdiction, they're also consistent internationally. Because as I said, people need to be able to compare the financial documentation that comes out from different places. So you cannot leave this entirely to national law to determine, and then you need somebody to translate the documentation from one jurisdiction and what it means for another one. It is much easier if everybody complies with international accounting standards, and then the documentation is instantly recognizable by everybody. And this is in fact what is happening here. You have international accounting standards that are determined independently. They're not created by a state authority. They're created by the accounting profession itself, that governments adopt and incorporate it in their national law. So the governments will create their own standards. They will accept what is out there as best practice by the industry, and then implement obligation in national law to comply with that standard when they're putting together the statements. If we don't have ways to assess financial performance, then we don't have a functioning economy. And financial performance is not to be taken for granted, especially in an environment like the one we've got now, that things keep going out of business every second of the day. Now, you remember the business with Patisserie Valérie that they went bust last year? You know what happened to these guys? They really had no clue what the numbers were, because there was fraud internally in the production of the financial information. So the person who was the chief finance officer was actually cooking the numbers. Not only the external people didn't know what's the status of the company, nobody knew what was going on because all the numbers were fake, and the numbers were fake going back 10 years. So what happened is at some point somebody noticed and thought, hang on, there's something wrong, let's look at what's happened. They started to look at the genuine accounts. They realized there's a big disparity between what the company has been publicizing and in fact what's going on inside. And then they start working backwards, and they realize that everything was made up going really back, right? And the financial guy got arrested and so on. It was like a big hoo-ha. The consequence of all of this is that you don't know if the numbers are fake. You don't know if the business is solvent or not. Why? Because businesses are not an issue of how much money do you have in the till at the moment. It's not even how much money you've got in the bank account at the moment. It is about how much debt do you have and how much debt do you need to service and how can you roll over those debts. Because all these businesses, everything that you see around you has got enormous amounts of debt, including this institution. This place has got enormous amounts of debt. So whether we know that Westminster is solvent and whether it's going to exist by the time you graduate or not is not determined by how much money they've got in the current account. It's determined by how much debt they have and whether the people who gave them the loans are willing to extend those loans in the future. The issue here is that for businesses that, like most of them, rather heavily indebted, if people start getting worried about whether your accounts are real or not, they're not going to renew the loan. So either they're going to call in the loan and they say you need to repay us now, or when the loan comes to its end, instead of extending it, they're going to say we would like to be. If a lot of these things come to be paid at the same time, then clearly the company is not going to have enough money in the bank accounts, and that's when you go bust. So this is what's happening here. This is what happened with Patisserie Valérie, but that was an accounting fraud here. So it's slightly different. What happened with Thomas Cook was the unwillingness of the people who had given them the loans to continue to renew those loans and to give them more and more time and more and more time. They just generally got spooked about the chances of the company and they wanted to be repaid. And if everybody wants time, obviously you cannot satisfy everybody. So how is all this information recorded? All the will produce type stuff that then they put on the websites and the financial press is talking about it. As I said, it's necessary that you produce this information and you make it public because there are lots of users of this information. You have to do it to comply with legal requirements, either in the statutes or in perhaps the rules of the stock exchange. You need to give information to your shareholders. You need to give information to your stakeholders. The managers need to know what they're doing depending on how much money is available. You need to also plan your business activity depending on what your financial performance is. So these things are crucial for the board of directors and everybody in any way associated with the company to figure out what they're doing. The concept of accounts, you will have an annual report that's published that shows you things like this. So if you're used to looking at that, it will immediately give you an idea as to whether these guys are making a profit or not. Or making a loss is also part of the business, right? It's not necessary that the business that has made a loss in any particular year is going to go under. It could be that they can sustain that loss because they've got enough money in the reserves, or it looks like they made a loss because they purchased a lot of great investments which are going to make them grow bigger in the future. So what matters for you is not whether they made a profit or not in this particular year. What matters is the whole structure of their money. And it looks something like this. You have an increasing complexity of financial information that the companies are giving out. The easiest thing to look at is the profit and loss statement and the balance sheet of the company. Now, the profit and loss statement will tell you very quickly what the turnover is, like how much money has passed through the company, right? It will tell you what's had. So if we have the company that makes the toilet flushes, if they sold £100,000 worth of flushes, but then in order to get them, they needed to pay £50,000 in the factory in China that made them. Okay, so the total money that they generated by selling them is 100,000, but they don't actually have 100,000 in the bank because they needed to pay 50,000 of that in order to get the items to begin with. But this profit and loss statement, or expenditure statement, gives you a very quick impression of what's happening in your company. So it'll give you an impression of whether you have a profit at this initial level or not. If you're selling toilet flushes and you're selling each one for £10, right, and you've sold 10,000 of those, your turnover is £100,000 worth of toilet flushes. Now, the cost of sales, as I said, is the cost of buying the items in order to sell them. So assuming that each one costs you £5 to produce in this factory in China, you need to pay £5 for each one of the 10,000 that you got, then you spend 50,000 in getting them in. So your gross profit is calculated by deducting this expenditure, this cost, from your overall turnover. Therefore, you've got 50. But that's not only that, right? There's more stuff. It gets more complicated because obviously you have additional costs. It's not only how much you sell the product and how much you bought it for. There's going to be cost of transport. You have office costs. Maybe you have marketing and advertising costs. Maybe you need to hire some people, so there are some employees' wages. You need to pay electricity for your stores. You need to pay all sorts of bills. Maybe there are consumables. There's a variety of things. So your account gets a little bit more complicated if you are including all these things to figure out how much money you're actually making if you include all your overheads. So if you include your overheads, then you get something that is more nuanced. Not only you've got the turnover, you have the gross of profit, but you've got all these things that you're going to deduct from the gross profit. So what you will end up then is building a balance sheet. But the balance sheet is a tricky document because it looks like, so this is like a more complicated version of your profit and loss statement, but the balance sheet looks something like this, which initially doesn't make any sense at all because it's got two columns. Things of value that you have in your company represent both the money that you pay, the money that people pay you, the money that you pay out, but also with the money that you pay out, you get something. So simultaneously, if you purchase the goods in order to sell them, you pay money to the Chinese factory to make them for you, but then once you got them, and they've got certain value. So it's not like this money disappeared, right? It's not like your rent disappears. But buy a camping tent, you paid money to buy the camping tent, but now you've got a camping tent that's worth something. That's why you end up with this double-side bookkeeping, because on the one side, it's got all the things that go out, and on these things that you purchased with the money that went out, that left you with a valuable resource. So it wouldn't be accurate to assess the financial health of your company simply by looking at how much money you've got in your current bank account and how much money went out, because perhaps with the money that goes out, you thought you're going to sell afterwards, so they represent some value. So what you do, on the one side, you've got all the money that is going out, and on the other side, you've got all the money that is going in. The idea of the double bookkeeping is the attempt to express on a piece of paper then the asset you have attained. So what do we have? So all these things are going to be represented now in your balance sheet. So when your accountant looks at it, he's going to be able to figure out whether there's enough stuff of value in there to leave you with a viable, alive business. You've got assets. These are the things that the business owns. And there are fixed assets. Maybe you own a building, maybe you've got cars, maybe you've got equipment, right? These are your fixed assets. Current assets are things that are turning around a little bit more quickly, because perhaps the building that you own, you're going to have for a long time, or the cars that you have, they're not that easy to sell. But it could be that your current assets could be materials that are waiting to be turned into some product that you're going to sell. Or it could be that products that you have that you're going to sell immediately. It could be that there are shares or financial investments. Right? You've also got all the people that owe you money. So this needs to be represented somewhere, because all the people that you sold stuff this month, maybe they're going to pay you at the end of the month. So some stuff went out, but you've got the incoming money. Next, so all these are the stuff that you've got. Some of them are things that you've got immediately that are coming in. Things that you can sell really quickly if you have to, and things that you can sell a little bit longer term. Next to this, you've got your own obligations. You need to pay money to the Chinese factory. You need to pay money to all these people that sent you the goods, that you got them, but you haven't paid them yet. You have to pay your bills. You have to pay your employees' wages. You have to pay your taxes. You have to pay all sorts of things. You need to service the debt. It could be that you have loans that you're repaying. The total amount of the loans needs to be represented in your balance sheet somehow, and also the cost of those repayments. So you have then a long line of things that are liabilities, and a long line of things that are assets. And you get to a situation that you produce a more complicated document. How do you know if you're solvent? So you've managed to put everything down on these documents. You've managed to represent the money in your bank account, the stuff that you've got that are worth money, the stuff that everybody owes you and you're going to get in the future. And then next to it, you've got all the payments that you need to make, all the stuff that you need to service, stuff that are going out, perhaps things that you need to get additionally that you haven't gotten yet. All of that is represented in these two broad categories. You're solvent if you've got the ability to pay your debts when they are due. A company that is solvent has enough working capital, meaning has enough current assets, to be able to service its liabilities that are current. You need to now, you've represented everything in your balance sheet and in those documents, but what determines your solvency is not the entire picture, but it is how your current assets match against the current liabilities. Because the structure of the law is such that if somebody comes and asks for their money today, be able to pay them back. And if that person is left unsatisfied, then if it is above a certain amount, the Insolvency Act gives them the right to go to the court and ask that you are put in an insolvency procedure because you owe them money and you haven't paid. Companies and businesses that are going bust are not businesses that are not rich, that they don't have stuff. They're businesses that have a mismatch between the current liabilities and the current assets. If you find that your current assets are lower than your current liabilities, you run the risk of not being able to respond if somebody comes and asks you for money. So if you're Thomas Cook, for instance, you knew that this is a very complicated balance sheet. You know that you're a wealthy company. You've got a lot of stuff, right? You've got a lot of planes. You've got a lot of rights. You've got the airports. All of these are worth money. So a company without value. There's a lot of value. There are a lot in assets. The problem is that if most of your assets are long-term, you cannot realize them immediately. If you want to sell your landing spots at Heathrow, it's not something that you can sell in a day. But your liabilities are immediate. A lot of people turn up and can come up and ask for their money right away, then you're in trouble. So either you have a situation that's slowly deteriorating because you find your current assets are lowering and your current liabilities are increasing, and you can see this coming, and you're trying to find ways to respond, or something bad has happened. It could be that something bad has happened externally to you. It could be that your bank gets spooked because of the overall economic environment and wants to take back its loan because the bank itself is suffering some crisis, and comes and says, look guys, I know that we said loan, but we're not gonna, so we're gonna have to have it back now. Please give us back 50 million pounds by Monday. And you suddenly, something that was a long-term problem becomes a current liability and you cannot match it. And then, if you cannot pay, then they can put you into that process. Normally what happens, if you see it coming, you try to work something out, or to push back the liabilities as far as possible. If you have failed to do this, because the current board is not capable, or they're not doing it properly, or they don't recognize the extent of the problem, and somebody begins the process, one of your unsatisfied creditors goes and begins the process, they put you first into administration. Administration means that they recognize that you have a viability problem. The board gets replaced by a team appointed by your creditors, and they try and sort it out. Maybe there is value in the company that your balance sheet can be rejigged in order to satisfy everybody. The company did not want to do it because they thought it was a bad idea for their business, a bad idea for their strategy. But if a new board is put in place by the creditors, now they're serving the interests of the creditors. They manage to do this, sell some of the assets a little bit more quickly than anticipated, then they can plug the hole, balance the scales again, and the company can survive. So some companies actually go into administration and come out of it as existing entities. If that's not possible, then the administration moves into the stage of liquidation, when the company is broken up and then the assets are distributed in different ways. And that's when you get the discussion in the press as to, is there a viable part of the business that they're trying to maintain or not? The company does not survive in its current form, but it could be that some of the recognizable kind of business expressions of it survive, in the same way that Thomas Cook bought by another brand, so the stores are still going to be there, the employees are still going to be there for a while. The business has not survived, but part of the business activities. So that's the key issue about solvency, and that's the idea of this double entry bookkeeping. It helps you get a dynamic view because it's a snapshot in time. These things change every day, but at least if you look at it today, you should be able to generate numbers that say, here's the long-term picture, but here is the short-term picture. Here is how current liabilities stack up against current assets. So if you want to book yourself a holiday and you're wondering about whether this business selling you this holiday is safe or not, maybe you can look at this documentation because it's available, and you can have some view of how risky they are. If the current liabilities and current assets are really matched together, then maybe they're not very safe because a little bit of a shock might put them under. If there's a safe distance between the liabilities and the assets, it's better. Now, the long-term liabilities and long-term assets is relevant to you if you just want to buy a ticket to go on holiday in a month's time. But if you want to become a shareholder, then that balance on that macro level will still be important to you. Do you want to be involved in this company? Does it look like this company is going to have a future? These are the beginnings of a very complicated set of documents, but luckily you guys are not accountants, so you don't have to go through all this of the complexity of all the aspects of the financial information, and I'm not an accountant either, so I wouldn't be able to explain it to you. But I think what this does is that it works as a good opening to the discussions we're going to have as to insolvency. So you can see this class as a snapshot into the company disclosures and the nature of the financial information that the company is meant to give. And that is a broad framework within which then we understand insolvency. Because from that, when we start talking about insolvency, we are just at the point that somebody comes and says, I haven't been paid, Therefore, I'm starting this process. But having done this class, hopefully you've got an understanding of how somebody ends up in the position that they've left. And the tragedy of it is that you could be owed a small amount of money. I mean, the amount of money that you need to be owed in order to process it's like £750 or something like that. So it does sound silly, but you could put Apple out of business if you've ordered a new iPad and you go there and they say, sorry, we don't have it for you, and we won't be able to refund you for a few days because we're suffering some problem with our current account. You are entitled to go and put them into that process. The next major things that are going to go bust in during this year, you'll be able to look at the financial statements and then go, exactly, it's like we saw in the lecture, this guy's done for.